Good morning, everyone, depending on which part of the world you are in. It's 5 p.m. IST and we will start on time. Thank you for joining us for the first, what we are calling episode of the Exec Edge. This is a new initiative by Aeka Advisors where we are creating a specially curated output where the intent is every month we will distill the key developments in the tax and regulatory space, but present it in a manner that's palatable and understandable to CXOs. We want to cut the legalese, cut the detail, and explain it in a manner that all of you listeners can take back and implement at your respective businesses. With that, what we thought we should kick off this series with is with an analysis of the new Income Tax Act 2025. We all live in interesting times, and I didn't ever imagine as a professional I would say that I've seen a new Companies Act, I've seen a new Foreign Exchange Management Act, and now I'm seeing a new Income Tax Act. And neither am I hanging up my boots, and nor are the draftsmen hanging up their boots. So we'll see what other new acts are there to come in the coming years. So that's the purpose of today's first episode, where at a very high level, but equally at a level that allows you to take specific decisions and insights back to your business, we will talk about various facets of the Income Tax Act. We've scheduled this for about 45 minutes, so we'll keep the presentation for about 35 to 40 minutes and leave the last few minutes for any questions that you may have. Please post them in the chat. With that, I'll request my colleague Indira, who has spearheaded this whole initiative, to lead the discussion. Indira, over to you.
Thanks, Abhishek. Yeah. So let me just quickly take a minute to tell you all what's on the table today. What are the themes of change? What changes and what stays under the new Income Tax Act? And how does it matter to you as a business? What decisions do you need to make? What are the digital shifts that are emphasized under the new act? And what is the impact on your compensation structures for your employees and executives? Then a section on impact on the M&A and restructuring aspects of your business. And what are the other new opportunities and savings or new optimization measures that are available under the new act? What changes in terms of compliance, governance, communication, internal controls and processes? What is the impact on your cash flow? And one main section is around transfer pricing. Is there any change to your positions that you're currently taking under the transfer pricing regulations? And a quick summary of all the key takeaways. Yeah. So as you all know, the new Income Tax Act 2025 is set to replace the Income Tax Act 1961 with effect from 1st April 2026. And what does it change? The main theme is simplification and rationalization of the provisions. Redundant provisions, obsolete provisions have been removed. Language has been simplified. Complicated provisos, explanations have been replaced with clauses and subclauses for ease of understanding and reference. Structural reorganization of sections. So, under the current law, there are many sections, relevant sections in some chapters, and some relevant sections are spread across other chapters. So the current act consolidates all the relevant provisions under a single framework or a consecutive sections. And one main important change is the replacement of previous year and assessment year with the unified concept of tax year. Under the current law, there has been, debates every time there's a budget or, every time you interpret a particular section, whether it pertains to assessment year or whether it pertains to previous year. So all these ambiguities are removed with a simplification in mind concept. So it's just one tax year that is going to be used going forward. Now, these are all the changes, but what did not change? There is no modification in tax rates, and there are no significant policy level changes that are introduced under the new act, except for whatever changes have been introduced via the Union Budget 2026. And the government has also recently released the draft rules. It is now open for public comments. We will also cover what are the provisions under the draft rules as and when we go through the rest of the presentation. And how does it matter if you're a founder or a promoter or a senior leader? How does it matter to you? What is the impact of the new Income Tax Act? It is fourfold. One is cash flow, then strategy, internal systems or ERP, and governance. So let me just quickly touch upon, examples of what kind of changes impact each of these buckets. When you look at cash flow, there are certain changes which might push refund timelines. So you will have to adjust, factor that into your cash flow statements or, into your budget preparations internally. Then there are certain compliance costs that have been introduced under the new law. It's a shift from discretionary penalty to mandatory compliance costs in case of non-compliances. Then there are certain revisions which may impact the employee cost structures. In terms of governance, with all the digital shifts and the new requirements that have been introduced under the new rules or under the small changes under the act, what are the new checks and processes you should introduce in your existing systems? What are the stakeholder communications? And in terms of strategy, are there any impact on your current positions, any tax optimization measures that are available that you can optimize on? And what is the impact on any proposed or future restructuring that you're looking at? Then there are many changes, especially on the digital side, which might require the businesses to, undertake changes in the ERP. Then how do you manage the data? How do you extract data? All these become relevant in the current context. So, as a first topic, let me just quickly touch upon what are the digital shifts that have been emphasized under the new act. So one is expansion of what is the meaning of books of accounts. So here, if you see, largely while under the current framework, any books of accounts in a digital format is recognized, but the definition of books of accounts has been specifically enhanced to recognize cloud-based storage. This could mean any records under your cloud-based storage. So SaaS applications, cloud databases could come within the scope of books of accounts. And even in terms of enhanced enforcement powers, there is a concept of virtual digital space that has been introduced under the new act. What this could, end up including is everything from emails, your cloud storage, social media, online banking or trading informations, digital wallets, and crypto holdings. While currently from an enforcement perspective, tax authorities are looking and asking for all of these data, but it was not so formalized or the powers were not so specifically given. But the Income Tax Act 2025 codifies it and puts it all in one place and empowers the tax authorities with formalized ability to seek all this data in certain specific situations like search or a survey. And the income tax department is also investing heavily in digitization. So they're able to, with multiple sources of data, they have introduced auto-populated forms largely. This is coming out from the new draft rules that were released. There's a greater pre-fill capacity under the new forms, and there's an auto reconciliation even before you submit the forms, based on data collected from multiple sources like banks, exchanges, brokers, etc. So these are all the largely the digital shifts or the themes of the digital shifts that have been emphasized under the new act. Now, what does it mean for you as an enterprise? One main important thing is that your books now live across apps and clouds. So that really means that people have to look at what is currently stored anywhere, any redundant data or any data that may not be strictly required. Revamping those, that is something that enterprises could look at. And in terms of, there is a significant amount of new data that has been data reporting that is required under the new draft rules. So look at data readiness perspective. Does your systems currently enable you to extract data quickly? And what are do you have internal processes and checks to ensure that any reporting across different regulations or in multiple countries are reconciled before you submit anything to the income tax department, be it a regular routine filing or an assessment? And another important point is also where Now, that income tax department has the ability to request banks and payment gateways to furnish data about the accounts or the cash flows that you hold. So one could think that you could look at is align vendor contracts to ensure that any data given to the department, or there are certain it is also furnished to you to be able to reconcile things. And any given the expansion in the definition of virtual digital space, or the introduction of new concept called virtual digital space, even the personal devices of employees, if it's being used for business purposes, will fall within that definition. Therefore, creating policies around segregating personal data and business data becomes important. Moving on, what is the impact on employee compensation structures? Now, many have been expecting, are there any changes in the ESOP regulation? The answer is no. Government has not changed the structure of ESOP taxation. ESOP continues to be taxed as salary or a perquisite on the exercise of ESOPs, and any accretion thereafter as capital gains. But what has changed is the thresholds of taxation or exemption for certain perquisites. These provisions have been, the thresholds have been there for quite a long while without any revision. So the government has now undertaken revisions in the valuation of perquisite thresholds in line with inflation and higher costs of living. There is a specific, or a large benefit that has been introduced for mid low income employees. So any perquisites offered by employers for employees whose income level is up to 4 lakh is completely exempt. And similarly, any medical expenses, overseas medical expenses incurred by employers for employees up to CTC of 8 lakh is again exempt. So there's a significant ability for employers to provide additional perquisites and benefits in a tax-free manner for people in the lower to mid-income category. I will give you some examples of the changes in the thresholds. So if you look at it, so from just to touch upon few examples, any gifts to employees up to 15,000 per year is exempt. And free meals, earlier the threshold was 50 rupees per meal. Now it has been increased to 200 rupees, up to which there's no tax in the hands of employees. Employer loans up to 2 lakh. Employer can provide a loan to an employee up to a threshold of 2 lakh, and that would not come within the interest-free loan. And similarly, HRA, earlier it was only limited to the 50% HRA threshold, up to which the house rent allowance was exempt, was only limited to Delhi, Mumbai, Kolkata, and Chennai, and the other cities had a lower threshold. Now, even Bengaluru, Pune, Hyderabad, and Ahmedabad have been introduced as metro cities. So, anyone living in these areas also get a higher house rent allowance exemption. Of course, having said this, all these are relevant only for employees opting for the old tax regime, whereas employees opting for the new tax regime, which have a lower level of tax rates, do not get any of these exemptions. So, what does this mean for employers? It means that you look at all the new rules once it is notified. It is currently in draft stage. Once it is notified, then you look at your compensation structure and remap it across different levels to ensure the maximum benefit is provided to employees. And with entry level and junior levels being having the ability to receive higher employer provided benefits in a tax free manner. Having said this, there's also a new labor law code that has been introduced a while back. So, impact of that should also be considered by employers in revising any employee-based compensation structures. Then moving on to mergers, acquisitions, and restructuring. One key change that has been introduced under the Income Tax Act 2025 is around demergers. Currently, under the company law, Indian company law, there are two routes of demergers. One where an application is made to the National Company Law Tribunal, which is a court-approved process. The other which is applicable for holding subsidiary relationships or smaller companies, can apply to the regional director. for approval of demergers. So this approval application to RD for demergers is considered typically referred to as a fast track demergers. Under the Income Tax Act, any demerger is tax neutral, which means the transfer of assets from one company to another through demergers is not taxable. Similarly, the shareholders who give up shares in the original company and get shares in the resulting company from the demerger, they are also exempt from tax. And this position was interpreted to apply to both demergers under the fast track route as well as the NCLT route. However, in the Income Tax Act 2025, demerger under the fast track route has been excluded from coverage for tax exemption. Post this, there was also an industry representation to the government where initially it was assumed that it was an inadvertent exclusion from tax neutrality. However, there was a response or a clarification from the Ministry of Finance, which said it was an intentional omission and not an inadvertent exclusion. Which and the reason that was quoted by the ministry is that RDs are less supervised, less court supervised, and there are more valuation related risks applicable, and therefore this RD route demergers have been excluded from tax neutrality. So now the question arises, does it impact your past demergers? Does it impact ongoing demergers and future demergers? In terms of past demergers, but this change is more a clarificatory change, and it was more an interpretation based position that was being taken in the earlier law. Therefore, there could be a risk that this change, tax authorities might go back to companies who have done demergers in the past under RD route and say this is, you're not eligible for the tax exemption. That risk is there. So the businesses have to analyze, does it really impact any of their past positions and how to deal with those risks. In terms of ongoing demergers, if someone has already filed an application under the RD route, they could look at withdrawing that application or requesting the RD to transfer that application to the NCLT. And for future demergers, of course, businesses have to take a conscious choice between going for the fast track demerger or NCLT, weighing the tax benefits or the tax neutrality. Because NCLT route is typically more time consuming and the costs are also more compared to an RD route of demerger. And there's another change which was introduced for buyback related taxations. This was introduced through the Finance Bill 2026, which is yet to be passed as an act. Earlier, so let me just take a step back and touch upon how buyback used to be taxed. Initially, buyback was taxed at the company level. The company undertaking the buyback had to pay a tax on the difference between the buyback consideration paid and the cost of the shares. And the income was exempt in the hands of the shareholders receiving consideration from buyback. Now, this was a few years ago amended, where the government considered any payment to shareholders from buyback as income, as dividend in the hands of the shareholders. This has now again been revised. Now, what the current regime or the proposed law provides that any payment to shareholders from buyback is considered as capital gains in the hands of the shareholders, and the company undertaking the buyback does not have to pay any tax, and this is not considered as dividends. Having said this, there is one exclusion. Anyone who qualifies as a promoter of the company will have to pay tax at a higher rate on any proceeds received from buyback, and this higher rate essentially aligns to your this slab rate. If you're a company, then that is 22% or 30%, and if you're an individual, then again it's 30% plus surcharge and cess. And again, if you're a foreign company, the relevant applicable rates. But this is an additional tax that has been levied for people who qualify as promoters on the gains or the proceeds received from buyback. So, promoter is someone who is defined as a promoter either under the Company Act or for SEBI regulations for listed companies. And it also specifically includes a person who is either directly or indirectly holding more than 10% stake in the company undertaking the buyback. Now, what does it mean to you? What does this change mean to you? It opens up the route of buyback, which might not have been considered earlier because of tax reasons. Earlier, it was a tax on dividend rate, which was the highest slab rate applicable. Now it is taxed at capital gains rate, which means long-term capital gains are taxed at 12.5% plus surcharge and cess. So the leadership, whoever are looking to distribute funds to the shareholders, could also look at buyback routes, buyback route as one of the routes for distribution of funds, or any other commercial reasons. Similarly, you could also look at any other restructuring that is currently ongoing or proposed and see whether buyback fits in anywhere in the restructuring or the scheme of things. Then, what are the other new opportunities or optimization strategies that can be considered given the changes under the current law? The Finance Bill 2026 introduced new, tax exemptions, or rather extended the existing tax exemptions given to entities set up under the GIFT in Gujarat, Gift City, or popularly known as Gift City International Financial Services Center. Currently, any entity or unit set up in the IFSC, which is primarily only for people in the financial services space, like AIFs, banks, finance companies, any income currently earned by these units set up in IFSC are eligible for a 10-year tax holiday. Now, this 10-year tax holiday has been extended to a 20-year tax holiday out of a block of 25 years, so 20 consecutive years. And after the expiry of the tax holiday, the business income of these units set up in IFSC will be eligible for a concessional tax rate of 15% each, as against the current 25 or 30% tax rates for companies. And other income streams other than business income will be taxable at prevailing rates in force. What does it mean for businesses? One is, if you're in the financial services space, you can assess setting up units in the GIFT or IFSC. There has been a lot of talk, and government is actively looking at promoting IFSC, and there, even from a regulatory perspective, a lot of things are being eased or enabled for enterprises. If people who are, there's another additional opportunity for people who are not in the financial sector industry, but you can look at if you are a multinational group or if you have a broader multi entity group. You can look at setting up a treasury center in the IFSC, which basically means that that entity in IFSC will manage all the treasury functions for the group, like funding, loans, investments, etc. Another important change that was introduced or proposed to be introduced in the Finance Bill 2026 is in relation to minimum alternate tax. As you all know, currently under the income tax law, there is a concept of minimum alternate tax, which means that if the tax on book profits is 15%, and that is lesser than the tax under the income tax law, then you have to pay a minimum tax of 15% with a credit offset available in the future years. There's a change in the proposed to be introduced in the Finance Bill 2026, which basically treats the minimum alternate tax paid as the final tax without any credit offsets. Another nuance is that under the current law, only people who have transitioned to the tax regime, the new tax regime where the tax rate is 22% plus surcharge and cess, effectively 25%, are exempt from applicability of minimum alternate tax, which means that only entities currently operating under the old tax regime of 30% or taxes have to pay minimum alternate tax. So, to encourage enterprises to move from the old regime to the new regime, the government has introduced MAT now as a final tax without any credit offsets, and the MAT rate is also reduced from 15% to 14%. And for companies transitioning to the new regime in this year or in the future years, They can utilize any accumulated MAT credits capped to 25% of the tax payable in any financial year for domestic companies and uncapped for foreign companies. And the MAT credit accumulated can be carried forward for 15 years from the year in which it was generated. But for companies who have already opted for the new tax regime before this proposal was introduced, are not eligible to use the accumulated MAT credit of the earlier years. Now, what does it mean to you for entities who are still following the old tax regime? You may have to do a scenario-based simulation to see, which works out better from a cash flow perspective, whether transitioning to the new regime or continuing under the old regime, or also determining the timing of transition to the new regime. And this will also have an impact on your current deferred tax asset positions if you are planning a movement to the new regime because of the cap of utilization of accumulated MAT credit only to the extent of 25% of the tax payable in each year if you are a domestic company. And if there are any deals ongoing, acquisitions or any mergers, etc., uh, the MAT credit could have also been factored as a cash or an asset. Now, with this change, this could also have an impact on the deal pricing. This is something you have to look at critically. And just also touching upon any REITs or InvITs, they face a comparative disadvantage because for any preserving pass-through taxation benefits for their ultimate, beneficial holders of REIT. The SPVs of REIT currently are under the old regime to get the benefit of pass-through taxation. If they transition to the new regime, then the pass-through taxation benefit is not available. So this is also something to be analyzed critically for REITs and InvITs. Moving on to what are the other changes which are more, compliance and procedural in nature. There's a concept, as a concept, penalties are being removed and the government is moving towards mandatory fees for any non-compliances. And this has been again introduced as a proposal in the Finance Bill 2026. Currently, for many of the non-compliances, the government has prescribed discretionary penalties that could be levied by the income tax officers. But the income tax officers also have the authority to waive the penalty if there is a reasonable case for defaults. Now, under the new regime, the government puts more onus on the assessee, and there's a shift from penalty based to mandatory fees based. To give you a few examples, if there's any default or non-compliance in tax audit reports, there's a current discretionary penalty of 75 lakh or 1.5 lakh. Now, this has been made as a mandatory fee. If there's a delay in filing the tax audit reports and the delay is less than 1 month, then the fee is 75,000. And if it's more than 1 month, it's 1.5 lakh. Similarly, the mandatory fees, penalty to mandatory fees shift has also been introduced for other provisions, other defaults like transfer pricing audit report default or specified financial transaction default. And what does it mean to you? This puts more thrust on the assessee to ensure timely compliances to avoid costly penalties. So ensuring adequate data availability, data extraction, timely validation becomes essential to ensure timely compliance and early task monitoring to mitigate any compliance costs on the enterprise. Another very important change is on the TDS or TCS correction statements. Currently, any TDS or TCS returns filed can be corrected or amended, up to a limit of 6 years. So from April 2025, a 6-year limit was introduced for any TDS or TCS corrections. Now, under the finance, from April 2026, this has been proposed to be limited to 2 years as against the current 6-year limit. So this puts more onus on the enterprises to make sure that if there are any corrections that has to be corrected within this 2-year limit. And in terms of the current deadline, for only past correction statements from the financial year 18-19 to 23-24, this should be filed before 31st March 2026. From 1st April 2026, these corrections become time barred. So ensuring that there are Any PAN mismatches, short deductions, wrong challan tagging, or vendor classification errors, this all must be caught now. So it's important to ensure that you relook at all the current filings and correct all these errors if any. Otherwise, this becomes time barred, and then that could result in a cash flow impact either for you or for the deductee. I will just also quickly touch upon some timelines which have been revised for the return of incomes. For original returns to be filed within the timeline of 31st July for non-audit cases or for businesses or professions, this has been extended to 31st August. There's a 1 month increase in the timeline. And in terms of revised returns, currently the revised returns can be filed anytime before 31st December. The government has now extended this up to 31st March with a small additional fee to be paid if it is being filed, up to this extended period of 31st March. And in terms of updated returns, currently under the Income Tax Act, there is a concept of filing an updated return, which is basically if the assessee has missed filing original return or revised return or a belated return or wishes to revise any of these returns, an updated return can be filed with certain additional taxes to be borne by filing the updated return. The timeline for this has been increased from 24 months to 48 months. Whenever there is a order, if the assessee has litigations pending at the tribunal or high court or supreme court levels, and the high court or supreme court passes an order, but the order has to be given effect to by the assessing officer. And currently, the timelines for this is 3 months with an extendable by 6 months. And if there are any verifications or hearings that have to be conducted by the assessing officer, they have to adhere to these timelines. Although practically in many cases, the officers do not adhere to it. But under the new act, the 3 month period has been extended to 6 months with an additional extendable ban up to 3 months. And if there are any verification or hearing cases, an additional time limit of 1 year from the end of the month of receipt of the order from the court has been provided. Now, this could result in delays in refunds, that arise because of favorable judgments. So, any delay in refunds will need to be factored in treasury planning. Another quick point is a lower deduction certificate. So, if a company is under losses or the tax rates are lower compared to any withholding tax rates that might apply on payments to that company, the company could apply or the enterprise business could apply to the government and claim a lower deduction tax rate. So any payer who has to pay the particular assessee or the particular business in question will withhold tax at rates lower than what has been prescribed under law. And now this lower deduction certificates earlier was only available for a few set of sections, a few set of payments. Now this has been enabled for all sets of payments. And the timelines for getting the lower deduction certificate will also are proposed to be reduced because the government is planning to introduce a condition or a rule driven exercise which reduces the subjectivity in or a discretion granted to the authorities in granting the lower deduction certificate. Then coming to transfer pricing. So one change that has been made under the new Income Tax Act 2025 is the definition of associated enterprise. So what constitutes associated enterprise under the current law is, introduced twofold or under two folds. One is a general definition which says anyone having control management or in the capital of an enterprise becomes an associated enterprise. And then there's a specific threshold which lays out things around someone should hold 26% voting to be an associated enterprise, more than 90% procurement from a certain entity, or a loan being above a certain threshold between two enterprises that could make them associated enterprises. There existed an ambiguity on whether both the general and the specific should be read together, and only if both are satisfied, then someone is an associated enterprise. There used to be debate and different interpretations around this. The new act effectively plugs this debate or interpretation and it removes a general and a specific definition. Currently, both the general and the specific definitions are merged, and there's only one set of one set of rule, and there are different thresholds within that rule, which people will have to look at to see whether someone constitutes an associated enterprise. Having said this, it also creates a wider scope for subjective tests. For example, because a general category is also one of the thresholds. So that means that even if someone doesn't hold 26% in a company, but there could be informal influence or common directors, shared management, and even if the 26% threshold is not met, these could be scrutinized more closely, and authorities could deem them to be AE. So this is again is a matter to be looked at closely, and enterprises should look at each of their AE relationships and see whether any of those are impacted based on the new reorganized definition under the new Income Tax Act 2025. Also, the Finance Bill 2026 introduces a new safe harbor provision for all entities under the IT/ITS category. Currently, there are different safe harbor rules for people in KPO, software, R&D, IT/ITS. But currently, the government has proposed to consolidate all of these subsectors under one main sector of IT/ITS and a unified margin of 15.5% under the safe harbor provisions. This is a significant reduction from the current 17 to 24% range. Also, who is eligible for the safe harbor, that has also been increased. Currently only enterprises having a transaction of 300 crores or less are eligible for safe harbor provisions, whereas this limit has been proposed to be increased to 2000 crores. And the safe harbor will be valid for a period of 5 years. So this, puts a emphasis on businesses to relook at their current transfer pricing policy and see whether opting for a safe harbor makes more sense from a financial standpoint. There are also significant disclosure changes in the transfer pricing report, commonly called as Form 3CB or 48 under the newly proposed income tax rules. So some notable additional reporting requirements under the new transfer pricing report proposed to be introduced is detailed benchmarks have to be disclosed, like what are the comparables, counts, percentiles, the retail computation methodology, margins. And also each transaction and each associated enterprise is allocated a unique ID for tracking. And if any transactions have been aggregated together, then those aggregations must be disclosed, which essentially translates to aggregations, not being beneficial, or rather, you have to report any transactions you have aggregated as what are the transactions which are aggregated and what is the quantum of aggregation and what is not aggregated. There is also a detailed requirement of disclosure around certain expenses like ESOP costs, employee travels, any shared data or server costs between the associated enterprises, or any costs which are borne by associated enterprises on behalf of the enterprise. There are also detailed transaction category drop-downs. Earlier, it used to be a broad-based transaction that has to be reported, but now there are detailed around, I think, 16 different transaction drop-downs that have to be selected for each transaction category. And there's also a specific disclosure around income arising from forex fluctuations. So what this means is that there is a shift conceptually from documentation based reporting to real time disclosure based scrutiny. So the transfer pricing officer will have most of the data to look at or initiate a scrutiny based on the TP reports filed, rather than waiting to initiate an assessment and seek more information from the companies. And given that there's a significant additional amount of data that has to be reported, enterprises will have to plan their transfer pricing studies and reports in advance to ensure timely compliances and adequate reporting and compliance. And it may also require some ERP related changes to ensure the right data is captured in the ERP for ease of extraction and reporting. This is largely on the key impact areas for leadership to consider. Now, what are the quick takeaways? I'll just take a minute to go through it. One is digital shifts requiring relook at your current data sets and compliance stack reviews. Relook at your compensation structures to align with the new perquisite valuation rules that are proposed to be introduced. And then look at any impact of these new changes on your current transactions, mergers, or acquisitions. And from a transfer pricing perspective, assess whether any AE relationships change or any new AE relationships are introduced. Look at optimizing on the new safe harbor opportunity and reassess data and compliance processes to ensure that the revised data reporting requirement is met.
Great. No, this was very succinct, Indra. Thank you. And you've been spot on. So I'll just give a minute or two for any questions that come up. But, a couple of things that I would just like to say in conclusion is I think while the government's efforts have been quite laudable, it takes a lot of courage to introduce a new act. We've seen several failed attempts. Some of you may remember the concept of a direct tax code that had come almost a decade back now. So to that extent, a new law is always a welcome change. One would have hoped it would have been simpler than the version it turned out to be. There's definitely some simplification, but in my view, it hasn't gone far enough. And finally, the proof of the pudding will really lie in how the administration changes their approach to tax collection and implementation of the new law. Because, I think we've all been to some extent victims of, unfortunately, oftentimes very harsh interpretations and lopsided orders. That's something that many provisions in the law have been brought in to curtail the draconian powers of the officers. Equally, they've made it more simple for taxpayers to comply, even on failed compliances. Penalties have been replaced with fees and so on. But again, the rubber will really hit the road only once we see actual orders coming in. We'll also have to straddle between two laws for the next maybe 3 or 4 years because some of the older assessments will continue under the old act. The appeals will still be under the old act. The procedures will still be under the old act. Although this year's budget has tried to rationalize most of those provisions between the two acts as far as possible. So very interesting times. I think we'll all have to remember two sections of the law at the same time. So again, a very challenging task for professionals and practitioners. So that's something we're all looking forward to. With that, trying to be on time again. If there are no other questions, we'll end the first episode. I hope this was valuable. We'll also share a recording on LinkedIn and our YouTube channel. And we'll be back next month on the second Tuesday with with the monthly capsule covering all the important changes that matter to you. Thank you for your time. Thank you, everyone.
Thank you, everyone.